Ladies and gentlemen, good morning. My name is Rudy Bogni. In typical business school style, I have 3 points to make. The first one is to welcome you all to this unbelievably 5th Capco conference on risk, and to congratulate Shaheen, that is Professor Shojai, for having made it possible. I'm sure that both CAS Business School and Capco would recognize that without his efforts, this would never happen, particularly the lineup of incredible speakers that is envisaged for today. The second is a very quick reflection on what risk has become over these past 20 or more years, where focus on risk has substantially increased, both from an academic and regulatory viewpoint. Risk has become a fully fledged industry, but it's also become a very interesting meta concept. There used to be, many years ago, a French communist leader by the name of Georges Marchais, who to every piece of news used to say, "C'est un scandale." So everything was a scandal there, and everything seems to be a scandal today. Everybody who gets something right or wrong provokes news, particularly if it's slightly wrong. Poor Theresa May, I think, was being questioned last night about her lack of proper legal risk management. King Juan Carlos had to apologize meekly in front of the cameras for poor reputational risk management, and so on and so forth. So risk has become really and truly all pervasive. But what is more interesting, and that's why I was saying meta risk, is what risk we're managing to. Are we managing CVA to credit risk, or are we managing CVA to the impact of perceived credit risk on the P&L and the balance sheet of banks, and so on and so forth? But I'm sure we'll get answers to many of these points during today's conference, and hopefully the speakers will help us distinguish between managing real underlying risk and managing cultural or socialized risk as perceived by regulators, legislators, media pundits, and so on and so forth. My third point and last point is to hand over first to Richard Gillingwater, who is the Dean of the CAS Business School, and then to Stephen Winicombe of Capco to welcome you here. Richard.
Thank you. Well, can I just add my very warm welcome to that of Rudy's. It's a great pleasure to welcome you here this morning. I think that it's actually great to see the auditorium so full, even at this very early hour. We are extremely pleased to be hosting this 5th CAS Capco conference. I introduced the first. And one of the really nice things about my job is just to see things taking off. And I think this has now got a real place in the London risk calendar, if I can put it that way. So I'm really delighted with that. We have a very strong tradition here at CAS in finance, in actuarial science, and many of our academics within those disciplines are obviously looking at risk and risk management. I would say, in an academic sense, it's very much at the heart of a lot of the work that we do here at CAS. So in a way, there's a real obvious complementarity. I particularly welcome conferences like this because what they do, and to my mind, maybe we don't have enough of this, but they really do encourage an exchange between, on the one hand, the academics, and on the other hand, the business and financial world, bringing together the real practitioners, the leaders, as well as the academic researchers. And I really, really welcome this conference and conferences like this. I also want to say, as well as welcoming all our guests here, I am pleased that a number of our academics are taking part in this event. And again, that's from our point of view, it's great to be involved in an initiative like this. I'd just like to pick up in a small way on what Rudy said about risk. I sit on a number of corporate boards, and I've done so now for the last 12 to 15 years. And I have certainly noticed, whether it's enough, but I've certainly noticed that the whole concept and alertness to risk management within corporate boards, and the thinking and the systemization of that thinking has moved on massively over the last 5 years. Now, the financial crisis might have had something to do with that. But I do think that in a really significant way, it's conferences like this, with people like you in the audience who are taking away the thinking from days like this back into your companies. And then actually what we're seeing is a very much more professional and systematic approach to the thinking about risk. And I really applaud that, because we absolutely need it in every sense. So I wanted to end there, just say that I hope you have a really great day, and that there's a very lively interchange of ideas. Thank you very much.
Good morning. I'm the last good morning before we get stuck into the content of this, so I'll try and keep it as brief as I can. My good morning is from Capco, a very proud partner in today's fifth conference. I think everyone has an immense sense of pride in the fact that it's number 5. My name's Stephen Vinaka. I'm a partner here in London, and one of my responsibilities is looking after finance, risk and compliance for our firm. So today is clearly of great relevance to both me and our team as we seek to better serve our clients in these areas. If you don't know Capco, please come and find one of us. There's a few colleagues with me here today. We focus professional services focused exclusively on financial services, and grew at 83% last year. So we like to think we're doing something right. We are working about 15 firms across the city, trying to help everybody figure out a way through the different cost squeeze, regulatory squeeze, and revenue challenges that everybody's facing. And it's very clear from our work that risk management in all of those clients has assumed more importance today than ever before. So it is the bunch of fives. It's the 5th conference. It's the 5th issue of the journal, which hopefully is weighing down your bags as we speak. I think that both the previous welcomes have alluded to the fact that it brings the very best of academic and industry thinking, and I think there's tremendous value in that, hopefully for you in your particular roles. Thank you very much for Cass for hosting us here today, and all of the panelists and speakers who are going to be providing their insight to the event. One of the things that we constantly hear when we're talking to our clients is the desire for them to spend a bit more time in an environment like this, stepping away from the day-to-day of actually very fierce deadlines and doing stuff, but the ability to take on new thinking, exchange ideas with peers, and then take that back into their environment and add value to what they're doing. So hopefully today provides that opportunity for you all. There are different challenges and opportunities facing the financial services industry today. Return on equity, which I'm not sure it's the right measure, but it is an oft-used performance measure, is back down in single digits for most of the firms that we're working with, and that's a significant decline from sort of mid-teens, early 20s from just 5 years ago, say. And clearly the way that risk is measured and mitigated is going to change dramatically through the latest wave of regulation. That's in turn driving balance sheet deleverage. It's constraining new product development. Cost bases are still being adjusted from business peaks of 5 years ago. And although the Euro crisis is not front page news every day, I'm not sure there are many people here that would say we're out of those woods just yet. There's some progress being made against some of those challenges. I mean, we're working with clients quite a lot on embedding credit, debit and funding valuation adjustments into to be proactive or pre-trade ways of managing risk. And although there's a lot of interesting debate about the accounting treatments that those methods are being afforded, it is a step forward in embedding risk into the way that firms are managed rather than a post-trade or reactive measure. People are also making progress on cost basis, so there's dramatic changes being made through M&A, outsourcing, industry utilities, offshoring, and so progress is being made there too. It's not all doom and gloom, there are new opportunities. I think that the CCP landscape may offer new opportunities for people to serve their clients, albeit with new risks, and I think there's a specific slot on the agenda today that will address that. Optimization of collateral and funding definitely offers real improved business performance, and collateral transformation may emerge, albeit for who is still unclear, a source of new revenue to the industry. We've got emerging markets, emerging technology, digital media, and
It's all right, it's all right.
It was digital media.
It's all right.
I think it may have to be analog media from now on, who knows. Yeah, and the government are encouraging new banking entrants too. So there are some reasons to not believe that it's all doom and gloom. Whatever else we can complain of, it's not boredom then. The banking industry is changing forever. And today's agenda is going to throw some real insight on that. As you can see from your agendas, we're going to cover 5 things: economic risk, financial risk management, regulatory risk, CCP alternatives, and the potential unintended consequences of government-sponsored clearing, which is a mouthful, but particularly relevant, I'm sure, to many in the room. And lastly, operational risk. Thank you all very much for attending today. I'm very confident that you'll find it of value, but I hope you do. Let's get going. I'd like you to join me in welcoming Blue Putnam, CME's chief economist, who is going to deliver the keynote presentation, Risk Management in the Era of Dissonance. So, please welcome Blue.
Oh, thank you very much. It's, see if I can, there we go. Always great to be back in London. I had the wonderful opportunity of having lunch with one of my old professors and former bosses yesterday, Professor Maynard, who worked at Chase and then Investcorp, and an advisor to the government in many cases. So I got another education at the Reform Club, which also I find quite fascinating. And you know, when you visit here, to really go back in history. Of course, they were reforming back in 1831. We're just getting there, I think, in finance. What I'm going to do today is take you through some sources of risk that are very slow-moving, so we sometimes don't pay as much attention to things that don't move fast. And then I'm going to talk about how these slower-moving forces are almost like tectonic plates that are causing some really difficulties in the management of risk. And then I'm going to come down from the 10,000 feet and fly a little lower and talk about what's going on now in the world to try to illustrate how these larger concepts are at play. One thing I'm required to do from the CME, since we run exchanges, we don't provide investment advice. I'm not allowed to do that. I just want you to trade. The sources of dissonance, the first one I want to talk about is population. And we all know about population demographics. These are they used to call these triangles, but there are pyramids, but they're not so pyramid-y anymore. This is the United States on the left and China on the right, young people at the bottom, working people in the middle, retirees at the top. And these are countries that are aging. They're not old, but they're maturing. And these are countries, Japan and Germany, that are actually already a little older. There are more people retiring than there are young people coming into the workforce. If Germany and Japan don't create one net new job, it's not a problem. So, you know, that's the kind of the mature country thing. And we have to kind of understand what that means about politics. If you're in a mature country, you care about health and wealth. You've made your money, and you're probably not going to make a lot more, so you want to keep it. You're in favor of the status quo. You don't like inflation, and you don't want your currency to depreciate. And then on the health side, you're not getting any younger, and you'd like your health system to be better than it currently is. And that's going to be the huge costs that governments face in these economies. So that's kind of the politics of the mature countries. Now, that's in contrast. This is Brazil and India. 50% of the people are under 30. There are almost no retired people. In fact, there are a lot of them, but there's many more people coming into the workforce. Think of the political dynamics in countries like this. Job creation. If they don't create jobs, the leaders lose their jobs, period. And it doesn't matter whether it's a democracy or a dictatorship or state capitalism. You know, you're going to have a problem if you're not creating jobs. And you're coming out of poverty and building a middle class. You're going to have many more frictions. You're going to have a higher inflation rate than mature economies tend to accept. So you have to have a higher tolerance for inflation. And then you really don't like your exchange rate to go up. In fact, you'd prefer it either be stable or depreciate a little bit because you don't want anything to disrupt this job-creating machine. So the politics of youth are just totally at odds with the politics of maturity. So we all know about demography and these slow-moving, I mean, demography is like watching paint dry. I mean, it really, you just have to kind of force yourself to think through it regularly. But it's a dynamic source of dissonance in today's economy. So we're going to come back to how that feeds into things. Before I come back, let me just show you what it has meant in terms of growth rates. These are cumulative growth rates over the last decade. China, India, and Brazil way outgrowing the US, UK, Eurozone, Japan. These are my forecasts for the next decade. I've kept the scale the same. You can see it's not quite as far apart. China, instead of growing 10%, grows at 6.5% a year. That, by the way, is a very pessimistic forecast. It just means they're still going to double and triple the rate of growth of all the mature countries. So that you still have all of this dissonance coming. So the growth implications are huge. Now, there's a second area of dissonance that I call property rights. Property rights, to me, are the things that you need to plan. Can you plan for the future? Now, those of us in the United States are having a real struggle with this because our current tax laws are going to expire at the end of this year. Our Congress was not able to agree on anything except that they wouldn't do anything, and so there are some automatic spending cuts coming in fiscal year 2013 that are pretty draconian, and fiscal year 2013, by the way, starts in October of this year. And then we have this debt ceiling thing that we hit periodically and which we're going to hit again in the spring of 2013. 2013 is kind of the key number here. We're electing a new Congress in November, and these people will be sworn into office around January 4th, and they will immediately have a honeymoon measured in nanoseconds before they're going to have to make very tough decisions or the economy is going to have a problem. Because we don't really know what our fiscal policy is going to be, what our tax policy is going to be. These are huge things that are uncertainties in the U.S. economy. But it's not just the U.S. that doesn't have property rights in order. You may have been watching the news with Argentina and Repsol in Spain. You know, it's not at all clear that that's a step forward in terms of property rights and ability to plan. Perhaps you've looked at what's been going on in India. Walmart is not building a big store there right now. Vodafone thought they won the court case so they didn't have to pay some taxes, but then they just passed a law to make the same taxes retroactive. Property rights are an issue all over the world, and those are the things that allow us to plan more carefully, and if those things are in flux, then we simply aren't going to grow as fast. The economy is going to have more dissonance in it. This, by the way, I just have one graph. This is the DoddFrank episode in the United States. This is the profits of U.S. financial companies. They've recovered from the 2008 shock, but then they've got a little dip at the end there, and that's because they don't have a clue what the rules are. We have the VOCA rule, but it's not really a rule yet. It's a proposal. And then we have many, many other things involved with this financial, they call it reform, but it's clearly not that. It's uncertainty, and so it's hit the profits already of these companies. Now, the third long-term theme that I like to talk about is fiscal constraint or policy constraint. When I was dealing with my marketing team, they told me I had to come up with catchy things. So these are the 3 Ps. We have population, property rights, and policy. The policy one is fiscal policy issues. And here we want to juxtapose it with the debt issues. This is a chart where we have the debt to GDP ratios, and the countries that are on the top tend to be the more mature countries that have a lot of debt. And they also have much slower growth rates going forward. Now, if you're in the world of corporate finance, do you lend to companies that are not going to grow fast, or do you want to lend to companies that have good, solid future cash flows? Well, you'd actually rather be lending to the countries on the bottom, maybe not the Argentina now, but the Brazils, the Mexicos, and Chinas. The other thing about this graph is interesting is that Greece is by no means the largest bar on the top. That goes to Japan, which has the most indebtedness. But the issue of indebtedness comes in 2 places in terms of this era of dissonance I like to talk about. The first one is that countries that have a lot of debt and aren't going to grow fast cannot grow themselves out of their debt, and they are going to have periodic crises, or maybe not crises, but disturbances around how much debt they have, and they're going to have fiscal austerity for a long time, which will be a further drag on their growth. Whereas the younger countries don't have as much debt, they have higher interest rates so they can cut them if they need to. They have many other ways to buffer their economies. So we're going into a period of dissonance in the global economy, and the mature countries don't have as many ways of dealing with it as the younger countries do. So those are the 3 big sources of dissonance I look at. When I put them all together, it creates an environment where we have many cases in which you kind of have the muddling through scenario versus the everything collapses into a total disaster scenario. We've seen that with the Greek debt and the sovereign crisis there, but even last summer in the U.S. with our debt ceiling thing, there was a small probability that Congress would be so stupid as to simply turn off and default on the debt. They didn't do that, but you couldn't totally rule it out if you understood how the Congress didn't work. And so you had these issues in which there's a low probability of something really bad happening and a very high probability of kind of getting through it. Now, that creates a distribution that many of us call a bimodal distribution. And that means, for among other things, that most of your risk models are wrong. I don't know about your risk models, but all the ones that I've built in the last 30 years have embedded assumptions. And I normally don't check the assumptions, although I'm learning to check them very carefully now. One of the most important ones is that things are normally distributed, or at least log normally distributed. Well, with these kind of low probability disaster events, things are not normally distributed. And then there's another assumption we make in our models is that prices are pretty continuous, that you can trade in and out all the time, even if prices are going up and down. But these kind of dissonances create big price jumps. When something occurs that changes the probability for the low probability event, that disaster event, maybe it gets a little more probable, then you have a big financial reaction, not because of the event not that your scenario has changed, but your probability of it has gone up a little bit. And that creates changes in volatility. Another assumption that's been embedded in all my risk models, and you might want to check yours, is constant volatility. We call that homoscedasticity, but in fact the world is full of heteroscedasticity, meaning that volatility is in fact volatile. Those of you in the options world call that vega risk. Greek letters were the fashion in the 80s. But whatever you call it, it's a hugely problematic thing for managing risk. So these kind of sources of risk generate probability distributions that are not well behaved compared to what we assume in many of our risk and portfolio models. My advice is not to throw your models out, by the way. My advice is to check your assumptions and become less confident in the result of your model. Simply be more of a skeptic about it, and I think that's better than throwing things away. But you be the judge. Let's talk a little bit about some of what's going on in the divergence of economies now. We're going to fly our plane a little lower, talk about what's going on in some of the economies. I see a lot of big differences in growth rates coming. I see the U.S. actually is doing much better this year. I see China slowing down more than people think. Europe is obviously not growing right now with the debt crisis. So we've got a lot of different things going on. Let me talk just a little bit about the U.S. This is an aggressive forecast, 3 to 4% growth in the U.S. this year. And people ask me, what data do you see to support that? I actually don't see any current data. I mean, there's some, but the data is quite volatile. It's full of seasonal adjustment issues. We're not going to know till way later in the year if this is remotely accurate. What I did see, though, is the forces that caused the slower growth have gone away. We had this shock in 2008. It was a big shock. And what we realized we needed to do was delever. Everybody, consumers, corporations, state and local governments, federal governments. And consumers, by the way, have largely in the United States finished delevering. Sometime around the middle of last year, they started taking on more shorter-term debt. And we also saw this in kind of the second stage. They started buying a lot more cars last year. So consumers finally were at that position in the United States where they felt they had reduced their debt. Now, some of this debt reduction came by default. They just didn't pay it. Some of it came by people actively cutting it back. Some people just cut their credit cards out. But it actually doesn't matter how the debt got reduced. The reality is that consumers started feeling that they could spend a little more from this lower base. So consumers started to be a little more active. Now this is profits. The top line is corporate profits of non-financial companies. The bottom line is the financial companies. In both cases, they've recovered from the 2008 shock. In fact, profits had recovered in 2010. It's just that in 2011 they didn't spend any of it because they were so scared of what was happening in Europe and so forth that they said, I think I'm going to keep my money another year and see how it goes. Corporations in the U.S. are spending more money this year. They are reinvesting in technology, upgrading a little bit. They're even adding some jobs. So we're seeing a little more dynamic. I don't have a chart on state and local governments, but they shed something like 250,000 jobs in 2011. State and local governments did not get the email in 2008 about how bad it was going to be. They were in denial in 2009. But in 2010 and 11, they actually took very tough steps to reduce their spending, lay off workers, and get in balance. And they also finished that job. So, if you kind of divide the U.S. economy up into 5 sectors, consumers, corporations, state governments, local governments, and the federal government, we have 4 out of 5 of the sectors that have finished their adjustment process. The federal government is the one that, of course, hasn't done anything. But that's not necessarily a bad thing. If the Federal Reserve, if the federal government had constricted the budget policy and raised taxes, it probably would have made things a lot worse doing that too fast. So, so this is my reason for optimism in the United States, is that the forces that were keeping us from growing with zero rates. I mean, the Federal Reserve is giving money away. The least we could do is borrow some and use it. But we don't care that the rates are zero when we're deleveraging. But we've stopped the deleveraging. We're like 90% done. And so now the economy can move forward. Let me talk briefly about the Federal Reserve for just one moment. Our Federal Reserve has gone to a more transparent policy. And one of the things that means is that 4 times a year they tell us what the FOMC members would think about when is the first year in which they're going to raise the federal funds rate. And in January, the 25th of January, they released this survey that they had done of the voting and non-voting members of the FOMC. And 3 people thought that the federal funds rate should go up in 2012, 3 people in 2013, 5 in 2014, 4 in 2015, and 2 in 2016. Now, Federal Reserve Chairman Ben Bernanke called this a central tendency toward 2014. I personally looked at this graph and thought it was a committee of individuals that didn't have a clue and had serious dispersion of views. So you can kind of take whichever one you want to look at, but they're going to revise this periodically. We're going to get a revision next week on April 25th. Now, since January, we have had a little better economic data, but our data is not all that reliable. So I'm not expecting too much change of opinion on April 25th. However, they'll give us another snapshot at the end of June, and then one around the 1st of November, right when the election occurs. It's the one when the election occurs that I think you might start to see some movement, because by then we really will have confirmed whether we're having a better economic year in 2012 or not. And if we do, then some of these people at the end may say maybe we should move the rates up. We do know who these people are because they make speeches. We know, for instance, on the 2012, that's Charlie Prosser at Philadelphia, Lasker, Fisher. We know the names of these folks. On the other end of 2016, that's Janet Yellen and Bill Dudley, the New York Fed. They give their little speeches to define the issues. We don't. The people in the middle are less interested in talking. They're more aware of what they don't know. Anyway, we have a lot of uncertainty about our Federal Reserve, but as the economy improves, or if it improves, these views will change. And one thing I always do tell people, the Federal Reserve gives guidance. It does not make commitments. And the Federal Reserve, so this 2014 guidance of interest rates in the Fed that Ben Bernanke has given, it's purely guidance. If the facts change, as John Maynard Keynes says, so will his opinion. And he will be quite happy to be wrong. If he's wrong, it means the U.S. economy is growing faster, and that means that he will have the opportunity as chairman of the Fed to take full credit for that, having done all the right things to make it better. So don't think of this as like a forecaster being wrong. These folks will be happy to be wrong, and they will take credit for doing the right things. So you should have much more uncertainty about U.S. rates than you might if you were listening to the Fed. Let me just briefly go to Europe. One of the issues about Europe that's been interesting for those of us at the CME, and it's going to be a session in the afternoon, is what happens to counterparty risk. But the European crisis of last year has become a debt problem because the ECB has lent €1 trillion to the banks, and at 1% for 3 years. If you give that much money to your banking system, you've taken the issue of liquidity off the table. And that was really why the Greek debt and the Portuguese debt was coming into such fear into the markets, was that we were worried about another banking crisis. The ECB took that off the table under Mario Draghi. It's not there. And in fact, I personally think we're going to see more lending facilities. He'll come out with another $500 billion at some point later in the year, probably. They're just going to make sure that nobody's worried about the banks. However, everybody has remained somewhat worried about the banks. And what we see evidence of that in the kind of data that I look at that I didn't used to look at when I wasn't, before I came to work for a futures exchange, I would have never really thought of looking at this data. But this is the trading volume in foreign exchange futures for the euro versus the US dollar, and it's gone up quite dramatically during the European sovereign debt crisis. And all that's really saying is that the end investors, the hedge funds, the pension funds that are taking some of these positions have decided to take some of it in the futures market where the counterparty risk is mutualized versus taking it with banks in the bank forward market. So that's one indicator for me that we're not out of this crisis, that people are still very, very worried about their banks. As I look forward into the future of Europe, I am also exceedingly worried because I don't think the leadership of Europe is on the same page with the voters. And the voters, in several important places, haven't had a chance to have their say. Europe, being the bastion of democracy that it is, made sure that neither Italy nor Greece could elect a new parliament while things were being worked out. Greece gets a chance to vote at the end of May. Italy will vote in September. In between, we're going to have Ireland, who's decided that they should have a vote on the EU compact for financial stability. It's not quite a treaty because, of course, the UK is not involved. So it's a compact. But I think what will happen is in Greece you'll find a lot of very small parties, so you'll have essentially a hung parliament. It will be hard to come up with any kind of reasonable compromises, so we're going to kind of slow down that process. In Ireland, I think there's a 50-50 chance that they will reject those treaties. I mean, they rejected the Madrid Treaty the first time around. Now they may reject these compacts. I'm sorry, they're not treaties for the lawyers in the room. And then Italy will also have a lot of small parties that move up in the ranks, and so another compromise government. Of course, I should have mentioned the election coming this weekend. You know, that will probably, the one in France will probably destabilize the relationship between France and Germany. So as the voters speak, I think it's going to be somewhat of a setback, or at least a pause in the technocrat solutions that have actually worked fairly well. And that will destabilize markets a little bit, but what it does, it'll put tremendous pressure on the ECB. And I think that they will simply throw a lot more money at it so that I will not worry about the banks. And then they'll let Greece and Spain and Portugal worry about themselves. That's Europe. Just China for a few seconds, and I'll close on China. I don't forecast annual growth rates in China. I do it by decade. You know, it's a country with a long history, and so I feel like I can give a forecast that will certainly I will be long out of this job by the time we figure out if this is true. But there are several things about China you need to remember, and it's an old country that's currently acting like a young country. These are average ages. And this is, India's very young. China will cross the U.S. in average age in 2022. We'll both be heading toward 40, which, by the way, as a country is not a good place to be. Japan up there is heading toward 50. China is a very old country, but it acts like a younger country because it has an enormous migration of people from the rural to the urban. They're moving something like 15 million people a year for the last decade, and it's going to continue for at least another 5 to 7 years. They're going to build a new London every year. That's a huge pressure on creating urban jobs. So they're acting like they're a younger country politically, but around somewhere in the next decade, the urban migration slows down, the aging process kicks in, and all of a sudden, instead of worrying about jobs, they're going to be in the health and wealth group, particularly the health group. I don't know if you know much about the Chinese health safety net, but it largely doesn't exist. So they've got a lot of money to spend on those things. So China's kind of in a very much transition decade here. I think I'm going to just close. I'm going to roll through a couple of pictures here. But I have one other to show you. when we're thinking about central banks and what they're doing, they're kind of in the background on all of this stuff that's going on. We have zero rates in the major countries and so forth. Central banks have actually been buying gold. And since 2008, this is ounces of gold, not dollars. And we've started to see central banks buying gold a little bit. And people ask me, what's the fate of the US dollar as a reserve currency in all of this? And, the challenge of the US dollar isn't another currency. The RMB in China is not even convertible yet, although I think they're going to speed up the pace of convertibility. It's obviously not a competitor yet. The euro, with all the problems in the euro system, the euro is not really a viable competitor yet to the dollar as a reserve currency. The real competitor to the dollar is what you guys do, diversification. If you are worried about your portfolios, you do not want 80 to 85% of it in US dollars. And so the role of the dollar as a reserve currency is going to diminish over the next decade, not because there's a competitor, but because the people managing central bank portfolios are going to want to have much more diversified portfolios than they currently have. These are pretty charts. We also have to pay a lot of attention to climate. One of the interesting things that happened in 2010 is we had so much rainfall in Australia, we actually lowered the sea level 6 millimeters. The climate changes that we see, we in the U.S. think we're in global warming because we had an incredibly warm winter. You probably think you're in global cooling. But the average temperature has actually declined just slightly over the past year. So we're going to see very much volatility coming from climate as well. But as I sum this up, what I see is that we have to be political economists. Politics matter more than ever. We have to follow voters. We have to understand the politics. We have to look at the property rights. Counterparty risk matters more than ever. The central banks want to have our back, but they're not that good at it. Foreign exchange markets are going to be the focal points. That's not everything happens simultaneously, but foreign exchange markets feel that pressure, and it's a good way to start your analysis. Asset classes are more interconnected than they have been in a long time. And what that means is your correlation structures aren't that stable, your volatility structures aren't that stable, your assumptions of normal distributions aren't that stable. Check all of your assumptions in your risk models. And I will stop with that. I think we have questions.
Thank you very much, Blue. Before handing over to the audience, there is one question I would like to put to you, which is less on the macroeconomic dissonance, but more on the specific you pointed out in terms of prices and so on. It's something which has come up in this context before. Now, it seems that in every discipline, everything looks like a partial differential equation, whether it's in finance, economics, in biology, or everywhere. Are we risking tailoring reality to the math we know rather than to what would make the analysis more significant? In particular, you quoted the discontinuity in prices. Can we continue to think in terms of continuous models when discontinuities seem to be a recurrent reality rather than a very occasional point?
Yeah, it's a very good question. I, for one, am not very happy about the mathemizing, how we would say that, of the economics profession. I use a lot of quantitative tools in my work. I do a lot of the math. I'm not very good at it. Most economists are not. But we've probably gone too far because as economists, maybe it's because we're not good at math, but we like to load our models up with simplifying assumptions. And if we put enough simplifying assumptions in them, then even an economist like me can finally solve the problem. Except that the simplifying assumptions that's where the devil is in the details. And so I really agree with, the thrust of it is that we've got to look at price jump processes. The Black-Scholes option model, for example. When Fisher-Black invented that, he put in 10 simplifying assumptions. Now, he could do some real math, but he still had 10 simplifying assumptions. Okay? When he went to Wall Street for Goldman Sachs, those assumptions became profit opportunities because he knew that people were using his model, Black-Scholes, and he knew that the assumptions were quite unrealistic. He also embedded the assumption of stable volatility and some other really interesting ones like nobody pays any taxes, unlimited borrowing at the risk-free rate, price continuities. So when he saw that some of these assumptions were being violated, he knew to switch to more complicated option models and take the people that were on their Bloomberg screens punching up implied volatility, he would take them to the cleaners. And that really means that, yes, we have to study these jump processes. We have to look way down deeper in our math, but we can't forget our intuition.
Yeah. Now we have this to circulate as a microphone.
And you, my French colleague has a question. I'm in big trouble.
Yes, very interesting. I share a lot of other things, but one or two points. You mentioned, I think it's one tend to be 100% in agreement, but maybe close to 100%. When you talk about the aging population in places like Europe, for instance, of course, it comes with the idea that there is a preference from status quo. But 1% growth, is that enough to cover the coming costs of aging? That is pensions, that is health expenditure, and isn't that an invitation to implement reforms that have never been implemented before? Because when times are good, why reforming? Crises are very useful for that. And I'm thinking about the extension of the working age, etc. Not miracles, because we are close to the so-called technical frontier. So we won't make miracles in terms of growth. But this is one point I wanted to say. Regarding the Fed, you had this normal distribution, sort of, thick queues, maybe. On top of the way people assess the economic situation in the US, you have probably in there also the influence of different positions. You mentioned Mr. Plosser from Philadelphia, for instance. This guy is probably convinced that the mandate of the Fed should change and just focus on prices and leave the rest out. So there are probably bias on the one way, on the other way, that adds something to just the economic assessments on people in the US like to engineer a new bubble just to cure the consequences of a previous one that has burst. You know,
yes.
Kind of thinking about that.
That's
okay, I won't speak about Euroland, otherwise nobody would speak until the end of the day. So you mess us with.
Well, there are two good questions there. One on I don't believe that the mature countries can grow out of this debt problem. And so I do take the point that could engineer a crisis that then results in some reforms that we didn't think were possible. However, I point out that getting from A to B is not really the interesting part of the analysis. The B part is not the interesting, it's the path. And the path normally has some detours in it. And so as you kind of people realize that maybe some big reforms or might be coming because they can add it up and see that it doesn't add up. One of the things that happens is that the political parties fighting those reforms can do very, very well. That is, we can have a populist movement that in the short term takes you in the other direction. And I certainly might see that coming in some European states over the next thing. The other question had to do with the FOMC and how it looked at, and particularly Charles Plosser, who's the president of the Federal Reserve Bank of Philadelphia. I think he has his PhD from the University of Chicago. That's not necessarily a bad thing, but it certainly does put you in the camp of being a little more focused on inflation. But I wouldn't accept the argument that he would want to get rid of the dual mandate. The U.S. In 1947 passed a law directing the Federal Reserve to promote price stability and encourage full employment. And so you have this dual mandate, but you only have one tool, basically the short-term interest rate. So you have a mismatch, or at least an inconsistency. You have more things to do, and you can only do one thing, so you have to make trade-offs. Professor John Taylor then gave us the Taylor rule that says you should weight them 50-50. In fact, of course, they don't do that. They weight one a little more, a little less. And right now, they are not really weighting either one of those. They simply want to provide, get the banking system back up and running and out of this 2008 problem, and they'll take risks on the inflation side. But I think when Charles Plosser is talking about raising interest rates, he's worried about inflation, but what he really wants to do is get monetary policy back to normal. And he would define normal, if I can put words in his mouth, as having the federal funds rate have a small premium above the inflation rate. In fact, what he would like is an economic policy. Let me see if I can find this. Brazil, the Central Bank of Brazil. The blue line is short-term interest rates, overnight Selic rates. The red line is their inflation rate. You can see that they, for the last 15 years, a nice steady premium and over the inflation rate. That is classic University of Chicago central banking. And of course, for Brazil, it's caused some enormous problems because it's gave them a very strong currency. It's hitting their manufacturing base. They've got super China risk because China fixes their country to the U.S. dollar. The U.S. has zero interest rates. So they're going to change this policy and lower rates faster over the next year or so than this suggests. But that's the kind of debate they're having.
Hello. You
Yes.
talked about leveraging in our balance sheets and how we seem to have stopped leveraging our balance sheets at the moment. Japan had a crisis 20 years ago and they're still managing their balance sheets. Do you think 2 years is the correct assumption that you're making?
Well, Japan, this is Japan's economic growth. And they did, they were growing at almost 5% in the 70s and 80s. By the way, in the 50s and 60s, it was 10%. And then they went to a 1.7% average over the last 20 years. Now, many people call that the lost decade. I call it 2% is not bad when you're not growing your labor force at all. It's a slight shrinking of the labor force. And they have a very advanced, efficient capital stock in Japan. So if you think about it, where is Japan's economic growth coming from? Technological progress, labor productivity. There's not, 2% is not bad when there's no labor force growth, no population growth. You're not going to get the consumer demand as your population ages. Young people spend way more than we do. So I actually don't view Japanese growth as a lost decade. I think they are managing an aging population exceedingly well. However, they do have this debt problem. Talk about leverage. The Japanese government, now what the standard answer is that the Japanese have lent the money to themselves, so it's not a problem. I don't buy that for a second. If I lent money to me, I would be very upset with myself. Okay? Lending to that kind of a credit. The deal they have is the Bank of Japan keeps rates at zero, and the banks can then fund the debt. And when that zero rate they've had zero rates since 1995. If that zero rate compact ever disappears, Greece is going to look really small. I think I'm...
No, we have another 10 minutes, Sarah.
Oh, I'm sorry.
I'll come.
You spotted somebody who's...
Yes.
Oh, sorry.
Please raise your hands if you have questions, and I'll bring the mic to you.
It was a very interesting presentation, Blue. You've touched on some interesting aspects of markets in terms of correlation dynamics, price dumps, even heteroscedasticity.
Yes.
One of the important indicators, of course, is the volatility of credit spreads. Now, when computing a credit spread, one needs to think about what benchmark rate do I use? Do I use something like LIBOR, or do I use a government bond rate, or do I use overnight index swaps? Now, this is something that is going to impact both policy formulation as well as pricing. Have you got a view on how one actually brings together these different views to form a view on what the rate should be as the benchmark?
I don't really think in the current environment it's so easy to get to a benchmark for these credit swaps and so forth, because in my economic theory, I'd like to use a more generic interest rate. But in fact, the reality is that you have to use an interest rate that's specific to the people involved in the transaction. And right now, everybody is looking at a different rate because everybody's credit perception is somewhat different. What we find is that the French banks are not too sure about the Spanish banks. The Spanish banks are selling their Italian debt. We're having a certain nationalization of the banking system as people worry about each other's counterparty risk. And that argues against coming up with a single benchmark interest rate. So while, as an economist, I would like to assume that I would use the risk-free rate or something like that, and so I would choose LIBOR. LIBOR turns out not to be risk-free at all. And so we're thrown, and then you could say, well, I should use federal funds or some overnight rate that the central bank controls, but then that's not what people can borrow at. And so the answer is none of the above, and that you have a very serious issue in trying to figure out how to price these things. And in fact, any security that has an embedded option in it of some sort or another is going to be the hardest security to price in these markets, because when volatility is shifting around, and you think about an option being embedded in a security, there are 5 things you need in just the simple Black-Scholes model to price an option, but we know 4 of them. You know, we know the strike price, and we know the current price, and we know the interest rate we can borrow at, and those kind of things. What we don't know, we have to forecast future volatility, and that's turning out to be exceedingly hard to forecast. And so any security that has any kind of embedded option in it is going to be much more difficult to price than vanilla securities. And that means that they're all going to be illiquid at the same time, because when volatility spikes, you won't be able to price a whole array of securities. And that means that things are correlated because of their characteristics rather than their cash flows. That is, if a security has an option embedded in it, it's going to have a correlation in a crisis, regardless of where the underlying nature of the security lies. So we're in a very messy situation where the devil is in the details, which is not good for me because I don't really look at the details.
Who's next? You have, oh no, there you are.
Thank you very much for a very interesting presentation. One thing you touched upon, and we didn't go into an awful lot of detail, was on the balance sheet expansion at the various central banks, ECB, the Fed, Bank of England. How is this addiction to balance sheet expansion, how's the end game going to be played out? Can the banks, can the financial sector be weaned off the easy money?
It's a good question about how we're going to exit this quantitative easing expansion of the central bank balance sheets. You know, as a young kid, you become very aware that it's so easy to get into trouble and so hard to get out of it. And so I think the central banks have in fact gotten themselves into quite a bit of trouble here. And I think they had to do it, or at least to some extent. So I'm not really arguing with what they did, but the exit strategy will be extremely difficult. Take the Federal Reserve, for instance. On September 16th, 2008, its balance sheet was slightly below $1 trillion. And today, the Federal Reserve's balance sheet is about $3 trillion. But the monetary system that it's supporting is pretty much the same size. So you really only need $1 trillion of Federal Reserve credit to run the banking system. The other $2 trillion is the expansion of the balance sheet. And so the Federal Reserve is essentially running a very large portfolio. And as it tries to think about raising interest rates, maybe in 2014, 2015, I don't know when, it's going to have to figure out how to fund that balance sheet, or it's going to have to sell the assets. My conclusion is that the Federal Reserve is somewhat addicted to that balance sheet, and they're going to raise the interest rate that they pay on excess reserves in parallel to raising the federal funds. And so the interest rate on excess reserves will essentially be their borrowing rate to fund the $2 trillion. It gets really interesting, however, when the federal funds rate crosses 2%, which, by the way, I think will happen by 2014 or so, not the guidance notwithstanding. And that means that a great many of the assets that the Federal Reserve has, about $1 trillion of U.S. Treasuries with an average coupon of 2% or less, they're going to be in a negative cash flow position. Those of you who run hedge funds know that that's really not fun. And so they're probably going to accelerate the pace of sales of assets. So I don't know when you want to get short U.S. Treasuries. Again, I don't give investment advice anymore. And I don't think you want to be short right now. But when the tsunami hits, it's going to be really bad. Now, the ECB's done it differently. The ECB did not buy assets. The ECB lent money to the banks. So that they have expanded their balance sheet, by roughly the same amount, but a very different way. And so the ECB, their problem is going to make sure that the banks manage out of this problem. So the ECB will have to wean the banks off the credit. And that they can't do unless the economies are performing better. So the ECB stuck with it too, but not for the same reasons. Japan is stuck with it because of the huge amount of debt that the country has. So they're all in it for different reasons, but they're in it for the long term. And I think the Federal Reserve will be the first one out, but it will destabilize U.S. bond markets considerably, and they just are going to try to wait till the economy is strong enough to do it. They are already starting to sell some of the more toxic assets that they have, but they're not selling the liquid ones. It's going to be a difficult problem. One last comment on that one. When you see a difficult problem and you know that it's a difficult problem and you kind of see it's not going to be a pretty resolution, we tend to fast forward our investment perspective on that, and I really warn you not to do that. There are people that have told me the U.S. runs trade deficits so big we're going to have a huge problem, and they're just always wrong on exchange rates because we've been able to bury that problem forever. Japan has been able to bury its debt problem. We're going to be able to bury this central bank problem for a long time. So this is going to be a topic for many conferences, but I would not rush to the screen to bet on this thing. This is something you should write about but not invest in.
Before closing, at the beginning, if I didn't misunderstand you, you made sort of a comment that we almost did sleepwalk into this climate of dissonance. Is that right?
A little bit, yes,
yeah.
Because some of these forces are so slow-moving that we didn't see them coming.
It triggered in my mind a memory of the story of why, one puts frogs to boil into cold water rather than hot water, because if in hot water they manage to escape from the pot as they realize what's going on, whereas in cold water they don't. And it brings me back to your point about the importance of politics going forward, which you put as your key conclusion. Now, we may all wish that politics has a positive influence, so it gives an upside. Unfortunately, in terms of certainty and uncertainty, it questions the property rights which you listed. If you had to make a comparison, the decade we're currently in versus the two previous decades, that coefficient of uncertainty from the politics, how much could it depress growth?
Actually, it probably depresses growth about 1%. You made up the question, I can make up the answer. We don't really know how much, but it is probably a significant amount because of the uncertainty. Now, as corporations and individuals see uncertainty, they do learn to deal with ambiguity. We have the decision sciences of how to make decisions under uncertainty. It's what all of us in finance know how to do. It's all about risk management. People, consumers, corporations will get better at it. And so the growth hit is in the beginning, and then they kind of learn to deal with it, and they move their money accordingly. They just don't necessarily, particularly corporations, move their money to the places where the politicians might like. I mean, the U.S. has a very interesting tax law about how it taxes the overseas profits of U.S. corporations, and so all their profits are overseas. That's not the answer the U.S. wants, but it's the answer they got because of the tax situation. Yeah. So, you know, our corporations around the world will figure this out. So it probably has a larger impact right now and a smaller impact going forward as we simply learn to deal better with these uncertainties. I have a great faith in our ability to adjust.
Ruth, thank you very much. It was a most stimulating talk, and as you can see, we all enjoyed it.